Live from New York City this morning. Good morning, good morning. Your equity market positive by 0.2% on the S&P, and the economic data looking good. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the labour market data looking rock solid. Bond yields climbing to multi-decade highs, looking to the Fed chief to address Wall Street. We begin with the big issue. It's over to you, Chair Powell.
Powell is obviously the most important voice to listen to.
Hopefully we get a little bit more clarity from Powell.
I think he'll be fairly hawkish.
More information coming out of Fed Chair Powell as to the intentions of the Fed.
We've read far too much into recent Fed speak.
The tenor of the comments from the Fed is, I'd say, shifted, become more hawkish.
The long end of the curve has done a lot of the work for the Feds.
Powell can point to that move and say, hey, look, the back end's doing a lot of work for us.
The rising bond yields that we've seen is doing some of their work for them. So if
the rationale for dialing it down just a touch is the huge backup in long-term yields.
Whether they hike or not in November or December.
The threat of another hike.
The Fed, I don't believe, is done.
Less inclined to hike further.
Our view is that they're probably done.
I think that the Fed is going to try to be quite patient, especially with real yields where they are.
The cumulative effect of all the tightening they've done already.
Joining us to discuss, JP Morgan's Priya Misra, BlackRock's Jean-Paul Van. Priya, let's get straight to it. This bond market sell-off, are these moves a substitute for further action from this Federal Reserve?
They absolutely are, but I think if you look at the recent data, we're not really seeing that in the data. So what the Fed, I think, is trying to do is buy time. I think they want to look for the data. I mean, the recession playbook is not working out. There's been significant rise in real rates. I mean, the entire COVID savings buffer seems to be largely gone, and yet the consumer continues to power away. So, I would argue that the setup for a recession is there, but how long does that take? Is that 6 months? Is that a year? Is that 2 months? I think we don't know. The market doesn't know that. The market's pricing the recession date, I think, much further out. But the Fed doesn't know either. And I think it's notable, the shift from the Fed over the last week. I think, Chair Powell's likely to emphasize that the market's done some work for the Fed. But are we restrictive enough? I think they don't know this, and which is why I think he's not going to take another hike off the table. But I think the urgency for the Fed to continue to hike, inflation is coming down. I think that urgency is just much less. So I think they're going to buy time, wait for December. If the data continues to power through, I think early next year we might be looking for more hikes. Why just stop at 125 basis point? But I think it's just too early for the Fed. So I expect another message of let's be cautious. We need to proceed carefully. There's been a very big tightening, at least on the real rate side. I think they're waiting to see whether that filters through across overall financial conditions.
Big move in this bond market, though, over the last few months. Let's go through it together. 2-year, 5-year, 10-year, 30-year. All in the last 24 hours, looking at new cycle highs. The 10-year at the moment, up a couple of basis points to 493, almost at 5% over the last few hours. Jean-Paul Van, this is the question that Andrew Honhorst over at Citi is asking. How will this Fed weigh the recent data relative to this bond market sell-off?
Yeah, I think they're focused on the bond market sell-off, and I agree with a lot of what my colleague just said. But I think, I don't think they know themselves what to make of this long-term rates backup. And I think as a result, we're going to be in a few months where we're going to see signals going in all directions. That's why we've now expect high volatility, two-way moves on 10-year. We've been underweight U.S. Treasuries on the long end for the last 3 years, and this week I've started to turn neutral. Not because we think rates will go higher over time, but I think now we're in a world where the Fed itself doesn't know what it's doing, so it doesn't know what to make of it. And so you've seen that through the speakers. I don't know what Chair Powell will say exactly, but I think they're concerned about the long end getting out of control, and that's going to dominate over, in my mind, the recent data.
Yeah, just to echo that, I think it's important. We heard that from Neil Kashkari of the Minneapolis Federal Reserve. Priya, he was perplexed by the move. Do you think they've got a decent understanding of what's driving all of this?
They look at bond market models and they argue it's term premium. If you look at why has term premium increased? Now, there has been a little bit more supply, but it's the buyers that have stepped away. And why have the buyers stepped away? Because we've heard from the Fed loud and clear, higher for longer. We've heard a Fed that's data dependent. Data inherently is lagging. The Fed is not really looking at forward-looking indicators. So I think the buyers, and we were buying early on in the move. And then once we broke those technical levels, we took a step back and said, we're going to need to wait to see where it settles down. I think we're nearing the peak, very hard to call the peak. But I think, back to your question on what drove the move, I think it was, to a large extent, the buyers getting nervous. It's paid to wait all year. If you're sitting out in cash, you're earning, 5.5%, 6%. And so why extend out the curve? The data has not supported it. Fed speak actually pushed back against it in September. I think the Fed is trying to undo some of that damage, but they haven't fully gotten there. I don't think the Fed understands how hawkish that September Fed meeting was, which I think took all the buyers and put them on the sidelines, and everyone decided we just wait, hang out in cash.
PPI was hot, CPI a little hotter than expected, retail sales big upside surprise. Let's talk about jobless claims. Mike McKee has the data. Morning, Mike.
Morning, John. I think we were both kind of gobsmacked by what we saw today, even with a United Auto Workers strike. The reference period for October jobs came in at 198,000. That is a decline from 211,000. It just keeps going lower and lower. And when you look at the ongoing jobless claims, the people who are still getting benefits, 1,734,000. That's a rise of only 34,000. It's the highest in 3 months, but historically very, very low. So jobless claims would tell the Fed, and it's the most recent indicator they have, that the labor market is still pretty tight and that there is still a lot of strength out there. So what do they do about it? That's kind of one of the big questions here, given that the data have come in stronger than expected. Now, when you look at what the Fed is going to be doing, we did have a little bit of a pop in November from 5.6% to 7.8% chance of a rate increase. That's not really a move. 34% still for the December meeting, but that's sort of hedging their bets at this point. The market's sort of leaning against any kind of Fed move by the end of the year. So it'll be very interesting to see what Jay Powell has to say, because as we mentioned, very strong growth. You've got the Atlanta Fed and now Bloomberg Economics now casts both converging on the idea of about 5% growth for the third quarter. The consensus a little bit lower than that. That may come up as we get closer to the GDP report in another 2 weeks. So keep an eye on that. And then you have to ask the question, and maybe David Weston will, given these kind of strong numbers, why are you considering not raising rates? Is it because there are higher real rates, or because you think that your rates need to go up? How high is higher and how long is longer if you're going to be higher for longer? What's out there that we should worry about? Commercial real estate, banks, recession? What happens to the economy next when we come out of this? Do we see interest rates go back down again? John Williams thinks so. And then, of course, since this is my hit, John, I'm throwing in a question I want David to ask. I'm not sure he's going to, but since we know Jay is a Dead fan, what's his favorite Dead song?
OK, that's coming up a little bit later. Opening question, Mike McKee on a Grateful Dead. Mike, appreciate it. David Weston sitting down, fireside conversation, fireside chat alongside Chairman Powell at the Economic Club of New York at noon Eastern. Do not miss that conversation. The Fed speak beyond Powell. Goolsbee, Barr, Bostic, Harker, Loken. Rest of the week, Harker, Mester. Then quiet period. No more of that. We heard this from Governor Waller in the last 24 hours. I believe we can wait. The full quote, I believe we can wait, watch and see how the economy evolves before making definitive moves on the path of policy. It is too soon to tell. John, you alluded to this. The prudent monetary policy move now, going into November. Is it wait and then reset in December?
From my perspective, I'm not sure if waiting would be necessarily the prudent move, because prudence goes on both sides. The inflation story is not over, but they have the financial side that is now in front and center in their mind. I think they will see prudence as trying to see what is happening in terms of tightening financial condition. That's kind of the frame they're applying collectively. And I think they are concerned about what that's going to imply more broadly, and they haven't seen the impact. So I think they'll interpret prudence as a lot of tightening is being done for us. I personally not sure that's the case. I think this is about, resetting to a new regime. We've been talking about that for a long time. I think we have a different view, I guess, on what's happening. But from their perspective, I think they'll interpret prudence as let's a bit wait and see.
Jean, you and the team have put out a new note on the tectonic shifts we're witnessing post-pandemic. Talk to me about that new regime. What we're witnessing right now. Is this the new normal, the old normal? What is it?
I think it's the new normal. I think we're in one of the core features of this new regime, it was that we were expecting rates to reset higher. The last decade was pretty abnormal. In some sense, the new regime is going back to something that's a bit more normal, but we think we're in this world. A 5% 10-year yield makes sense in this world. I think, when you look at the next 5 years, this is what it's going to look like. And that leads to pretty profound adjustment. And that's why we talk about mega forces. We think for investors, the opportunities are probably more by harnessing what these mega forces will do. And one of them is like, how does financial system really adjust this to this higher rate environment when we've made big change since 2008. There's been big fundamental change, the structure of the financial system that we haven't seen the impact until the rates start to go up. And now we're starting to see that. I think the role of bank issuing credit is evolving. I think credit will have to come to other places in the financial system over time. And that's the kind of structural tectonic shift that I think we need to follow, harness, and where returns will be.
Priya, is that a view that you share?
So I would argue there were elements of 2008 to 2019 that were abnormal. But, you look at a lot of other trends, productivity, demographics, I think inflation, a lot of these, we would argue, are still very much present. I mean, is the Fed going to be as aggressive? Are they going to take rates down to zero and do significant QE? I think it's going to take a pretty big shock to get there. So I do think there are elements of the pre-GFC world that are going to be more relevant. But I would still argue one of the things that's very hard to model is that the lags might actually be a lot longer. I know the Fed argues that the lags are shorter between monetary policy and the economy. I would argue the lags are much longer. The fact that businesses, households, everyone termed out their debt. So if I've locked in a low mortgage rate, well, the housing market's going to get frozen.
Yeah.
What breaks that will be ultimately either home prices have to fall or we get a recession. So I would argue that 5% is still attractive. When you're a flat curve, when cash is giving you 5% and the 5 years giving you 5%, I think extending duration and significantly looking at corporate balance sheets. I think that's active management is going to become really important because cost of capital is going to be higher in this new normal. I'm just not convinced that we're not going to go down in terms of rates from here.
Priya, I'm not convinced that we fully realise the shock associated with the rate move we've seen in the last 3 years. Just take a step back and think about what's happened. In the space of 3 years, we've had yields at multi-decade highs and the lowest rates ever in the space of 3 years. And I was looking at a long gilt, 30-year issued back in 2020. When that was issued, look at the move we've had since then. A move of something like 50 to 60% lower in price. Priya, can we go back over something you and I have touched on before? Have we fully realised the pain associated with the losses in bonds over the last few years?
I would argue not. No, I mean, I think fixed income portfolio managers maybe, but if you're in the real economy, you're a company that's termed out your debt, you're a household that is locked in a low mortgage rate, it's just going to take a while. At some point, you move your home and you have to then deal with a 8% mortgage rate, or you have to refinance your debt. I think, everyone's been hoping for interest rates to fall next year. If the Fed is not going to cut rates next year, and if the 10-year is going to stay at 5%, I think it's going to start to impact. I think the hard thing for us is that a 6-month or a 1-year lag from here? And I think we have to sort of live through this period, start to think about how to position for, essentially to your point, where the real rate, and I would say it's not even just the nominal rate. Look at real rates. 2.5% real rate is a pre-GFC average or on the higher end of the average. So I would argue, that pain of high real rates will be felt over time. You just have to sort of survive this period while that pain is still not being felt.
Jean Bavin, how are you thinking about the same thing?
Well, the first thing I would say is, and we've talked about that a few times on this show, John, is we don't think this is an expansion. This is not a cycle, right? This is, we've been restarting. I think that's the lens that changes everything. I mean, even when you look at the tightness of the labor market, it's tight, it's not strong in our view. We're adjusting to a new structural reality. and that's taking some time. So that's the first point. I think when I think about rates and long-term rates in particular from here, I think I want to distinguish between what's going to happen to the risk-free rate or the policy rate. They won't stay at the level that they are for the next 5 years. So I agree with Priya that that's likely to at some point require some adjustment. But that doesn't mean that the 10-year is going to go down. I think there's a term premium. There's a compensation for holding duration that investors are clearly living through over the last 3 years. The volatility is just like completely surreal. And when you experience that, there's going to be an ongoing kind of term premium that's going to have to reappear. So I think you get to a place where, real rate can go down, and at the same time, long-term rates can stay around 5 because there's going to be a need for greater compensation for holding that duration.
Priya, what's your response to that?
I would say when risk-free rates rise or treasury rates rise, it's a tightening in conditions across the board. So do bonds come back as a diversifier? I would argue once the Fed is done, if the economic data starts to weaken, risk assets start to struggle, that term premium that seems to be breaking out starts to come back down, because now I want to be in 10-year treasuries over the stock market or over, high yield credit, private credit. So I would argue there's a cyclical component to term premium as well. So that compensation for duration starts to go down if the economy starts to weaken and risk assets start to struggle. So that diversifier aspect can be an offset. So the front end, I still prefer the 5-year over the 10-year because we still haven't seen enough in the data. But if the data starts to turn, I think that compensation starts to go down because you really want to be in that risk-free 10-year treasury.
Priya, Jean, thoughtful stuff on a bond market. Priya Misra, Jean Bavin on the latest on bonds. We have seen cycle highs on a 2-year, 5-year, 10-year, 30-year yield, all in the last 24 hours. Right now, equities positive by 0.2%. Let's get you some movers. Here's Abby.
And beneath that relatively calm surface, John, we have some very big movers, starting out with the shares of Netflix. I believe that we're looking at the best potential day since January of 2021. Shares are absolutely soaring, and actually now we might be higher than those levels. But they added 8.76 million subscribers, one of the best quarters relative to subscriber adds in years. The password crackdown helping, and they're also going to be raising some prices in some areas. VMware down on a report from the FT that China is working to hold up its potential $61 billion buyout by Broadcom. And then Tesla, the other big tech mover, to the downside, down 6.6%. They, of course, missed earnings by 10%, margins below what had been set as a floor by the previous CFO. The growth outlook also tempered on rising rates. So two different directions for those first two big tech company reports that we have out, John.
Abby, thank you very much. Coming up next, the latest on the president.
My ambassador's down there in Cairo now. He's going to coordinate this. He has my authority to do what is needed to get it done.
Team coverage up next.
My goal was multifold, but basically to get humanitarian aid into Gaza. He agreed that what he would do is open the gate to do two things. One, let up to 20 trucks through to begin with. Satterfield, my ambassador's down there in Cairo now. He's going to coordinate this. He has my authority to do what is needed to get it done.
President Biden attempting to ensure aid enters Gaza, capping his quick trip to Israel with a primetime address from the Oval Office later this evening, discussing the attacks against Israel and the ongoing war against Ukraine. All this coming as the U.S. eases sanctions on Venezuela, lifting restrictions on the country's oil production in response to dramatic democratic developments and potentially an open election. Team coverage starts right now with Ollie Crook and Anne-Marie. Morning, Ollie.
Hey, John. Yeah, as you mentioned here, the focus really squarely is on aid. The UK Prime Minister is here. He's been talking to Benjamin Netanyahu, offering the same kind of support that we heard from Biden yesterday. But this question of aid, where everyone seems to say, OK, we're ready to move on this, and yet the aid is not moving. So that is going to be the number one focus. In terms of the risk radar in the region, we should say that a number of Western countries are now warning their nationals that are inside of Lebanon to begin to prepare themselves for vacating. We've also had Hamas over the last couple hours calling for another day of raids stage. That is coming tomorrow. And then again, that sort of stop that did not happen in Jordan, where Biden was supposed to meet with Arab leaders. We're supposed to have an Arab leader summit this Saturday held in Egypt. So perhaps we can get a unified front there and a message from those leaders on how they think things should proceed.
MH, can he get a unified front at home in America, in Washington, within his own party?
Well, Jonathan, that's going to be the pitch this evening. The president will be giving a rare Oval Office address, really going into the homes of Americans, making this direct appeal. But, Jonathan, it's not just going to be about Israel, which we do note that there are some members, very left members of the progressive wing of the Democratic Party that are struggling with really the president's message on Israel. But he's also going to make a pitch about Ukraine and Putin's invasion of Ukraine and how the United States needs to fund the national security concerns of all their partners. We know that this is on potentially the heels of the president about to ask Congress for $100 billion in aid for Israel, Ukraine, also countries in the Indo-Pacific like Taiwan, as well as, Jonathan, security for the southern border. Given the fact that there's a lot of disagreement amongst a lot of these national security issues, especially when it comes to Ukraine and when the Republican Party, the White House is really going to cast a wide net, and hopefully with all of these issues in one bill, it can garner enough support.
AMH, and just to wrap things up, a really difficult poll for the President of the United States from us teaming up with Morning Consult. What's your read on that?
The read is that the president has a lot of work to do, even though we are more than a year out from next year's election. We really need to take the timeline into account here. But the president has a lot of work to do if he wants to remain in the White House come after next November's election in these swing states, especially, Jonathan, the fact that he won the majority of them. He has a lot of work to do when it comes to the economy. The economy ranked once again as #1 top of mind of voters, especially inflation, Jonathan, where voters just feel like it is eating into their disposable income.
AMH, thank you. The latest on the ground in Washington and over in Tel Aviv in Israel. Ollie, thank you to you, sir. Equities right now positive 0.1%. Up next, the morning calls, and later, Stifel's Barry Bannister says stocks peaked last summer. This conversation up next. Five minutes away from the opening bow. Stocks a little lower on a Russell, higher on the S&P by 0.1%. As the price action, here's some morning calls. First up, Cowen. Downgrading Canada Goose to market perform, seeing limited upside due to consumer headwinds. Your second call from Bank of America, downgrading Peloton to underperform, pointing to aging subscriptions and declining engagement. That stock down 5%. And finally, KeyBank, upgrading Netflix to overweight after earnings, expecting the company's paid sharing feature to boost subscribers throughout the next year. Coming up on this program, a tale of two tech earnings. Stifel's Barry Bannister discusses his outlook for big tech as earnings season gets underway. From New York, this is Bloomberg. 25 seconds away from the opening bow this morning. Good morning to you. Pushing higher by 0.1% on the S&P 500. Tough day yesterday across the board for equities. On the Nasdaq this morning, bouncing back by 0.4. We'll talk about those numbers out of Netflix in just a moment. The opening bow in New York City ring. Switch on the board and get to the bond market. We look a little something like this on a 10-year. Yields up by 3 basis points. 4.9449. Very close to 5%. A little bit earlier in the session on a 2-year maturity. 5-year, 10-year, 30-year. Take your pick. Cycle highs across the board in the last 24 hours. In the FX market, the dollar's shown a touch of weakness even with those moves in the bond market. The euro 105.67. We're positive on that currency pair by 0.3%. And easing sanctions on crude production in Venezuela. Crude pulling back just a touch, down 1%, $87 and about 50 cents. About 30 seconds into this session, a lift on the S&P by 0.2%, on the Nasdaq by 0.3. One stock to watch at the open, Tesla. Shares under pressure after dialing back growth expectations due to higher interest rates and cautious consumers. Elon Musk saying this: Tesla is an incredibly capable ship. We're not going to sink, but even a great ship in a storm has challenges. Eduardo has more. Morning, Ed.
Good morning, John. This is a big drop in Tesla's shares. At this level, it's on track for the biggest decline since July, now trading at its lowest level since August. The story is that it is a difficult environment out there. And if you look at the sell side or analyst response, a number of firms have cut price targets. And of course, now starts the reevaluation for forecasts for 2024. But the read across between them is that expectations going into this quarter for Tesla were low. What came out in terms of financial results in the quarter gone was even lower than those low expectations. Adjusted EPS, 66 cents a share. The forecast was 74 cents. The story of the year has been price cuts, and we've seen how that's impacted the bottom line. On the top line, revenue of $23.4 billion was below the $24.06 billion in sales that analysts were expecting. But the key metric that you watch is automotive gross margin, excluding regulatory credits. That data point came in at 16.3%, which is the lowest level in 4 years, well below the sort of floor that previous CFO Zach Kirkhorn had put in place. And now starts the debate about valuing Tesla as a car company or as a technology company. Wall Street was looking for automotive gross, excluding reg credits, of 17.7%. I think you and I are going to talk later in the show about the bigger picture narrative from Musk, the growth trajectory. But this is a big move lower in Tesla, down 6%, biggest drop since July.
That valuation question is the question. Ed, thank you, sir. Down 5 or 6%, as Ed pointed out. Here's a view from the south side. Wedbush, Dan Ives doing this, cutting the price target to 310. Here's the quote. We would characterize last night's conference call as a mini disaster. The street wanted to get their arms around the falling margins and constant price cuts. Instead, we heard from a much more cautious Musk, focusing on higher interest rates and the difficult path for Cybertruck production. The latest there from Dan Ives of Wedbush. The stock lower this morning. In early trading in the first 2-3 minutes of the session, down by something like 5 to 6%. We're down 5.3% currently. Your second story, in the other direction, Netflix raising prices after posting its best quarter for sub growth in years. The company writing this: we've shown that with discipline and a focus on the long term, you can build a strong, sustainable streaming business. Abby has more. Hey, Abby.
Hey, John. Investors really like what they've done with the past quarter and the outlook. The stock is soaring, having its best day right now since January of 2021 at the highs at the open, up 18%. At that point, the best day since October of 2016. So a big reward here for these results. And what investors are really honing in on is the big subscriber add. 8.76 million subscribers were added in the third quarter, blowing out analyst estimates. And it's also one of the best quarters for subscriber ads in years. Now, why it is so important, it puts them on track to add 20 million subscribers this year. When you compare that to 9 million in 2022, well, it's more than a doubling. It shows that their password crackdown is working, and they're also saying that their strong content is really helping out the results, so much so that they have confidence to raise prices, as you mentioned, by $3 to $23 for its big plan here in the U.S., the basic plan by $2 to $12. They will do similar raises in both the U.K. and France. A couple of analysts on the street, John, very excited and positive on this. Morgan Stanley upgrading the shares of Netflix to an overweight, also raising the price target to $4.75. Big upside there. And Truist upgrading to a buy. Netflix absolutely soaring on the day. Big results out of the streaming company.
396 in early trading and still climbing. Abby, thank you for that. Let's stick with earnings. Las Vegas Sands authorizing a $2 billion buyback program. The CEO saying this: we were pleased to see the recovery in travel and tourism spending. We remain deeply enthusiastic about our opportunities for growth in the years ahead. Katie has the story. Hey, Katie.
Hey, John. Yeah, there's two factors that's pushing Las Vegas Sands higher this morning. First, of course, the third quarter was a beat, but it's really that $2 billion share buyback that's really driving the stock higher this morning. This is the first buyback since 2020. And of course, this follows Las Vegas Sands reinstating its dividend last quarter, which had also been halted in 2020. So you take those two together, and it's really a clear signal of management's confidence here. You take a look at what the sell side is saying. Citi noted this morning that the buyback shows that management believes that where the stock is trading right now does not reflect the company's fundamentals, while Barclays called it, quote, a nice surprise, and noted that the third quarter results were better than feared. All of that clearly working through the shares this morning. You take a look right now, currently almost 4% higher, though I'll note it's still lower on the year, John.
Katie, thank you. Up to 46 26. Let's turn to the telecom space. AT&T raising its annual free cash flow guidance after topping mobile subscriber estimates. The CEO saying the following: "We're gaining profitable customer relationships and becoming more efficient. This is powering our strong business performance." Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, the beat and raise here, driving shares up higher, the most since July on an intraday basis. A lot of the focus was around the full year cash flow outlook that it was able to increase. Now seeing a full year cash flow at about $16.5 billion versus the $16 billion that was anticipated. This speaking to the success of the company's cost cutting program, also able to raise earning guidance here. All of this, though, on the back of those gains in subscribers. 468,000 net new mobile subscribers in the third quarter. That's well above estimates. And this after 4 consecutive quarters of declining subscriber growth. You know, there's a lot of competition and broader headwinds in the industry, especially AT&T just lagging the 5G network build out that the likes of Verizon and T-Mobile have done. It has a heavy debt load, and we still don't know what the costs are going to be of cleaning out the lead from its old copper phone network. But Citi here saying this strong growth in postpaid subscribers is a positive net data point for the industry. We seem to be watching Verizon shares rally a little bit in sympathy. And this, mind you, is before the accounting for a lot of those iPhone subscription sales and promotions that we saw at the end of September. So maybe a little bit more positive news ahead, and that's why we're seeing this 6.4% jump.
Big gain. Simone, thank you. The latest about 7 minutes into the session. In the equity market, positive here by 0.1%. On the Nasdaq, up by about 0.2%. In the bond market, plenty taking place. I've said this a few times today. Cycle high on a 2-year yield. On a 5-year, 10-year, 30-year, all of the past 24 hours. Currently, yields up at the long end, just a touch on a 30-year by a couple of basis points, call it 3 basis points higher, just north of 5% on a 10-year, getting closer and closer to that line in the sand over the last day or so. That 5% line, 4.94, yields up a couple of basis points right now. Stifel's Barry Bannister seeing limited upside for equities over the next 12 months, right in this. Our view remains that the S&P 500 peaked in the summer of 23 and see mid-4,000 through the middle of 2024. Barry, I'm pleased to say, joins us right now. Barry, fantastic to catch up, sir, as always. For people not familiar with your call, let's work through it together again. Why do you see that peak back in the summer and limited gains, muted price action for the year ahead?
Yeah, we got off the bullish train in the summer of 23. Our view is 4,400 at year end this year, and it's actually new information. We think 4,400 all the way through the middle of 2024. The problem has always been the normalization of interest rates. If you look at the 10-year real yield, the Treasury Inflation Protected Security or TIPS yield, it's when it burst through 2000, the market ran into through 2%, the market ran into trouble. It went to 2.5, and if you look at the TIPS yield equivalent for the 45 years prior to the year 2000, it was 3%. 2000 was a seminal year. It began 5 deflationary shocks in 20 years. Now the Fed is leaving that deflation behind. We're normalizing rates. If we go to a 3% TIPS yield, it keeps pressure on the price earnings multiple of the market for a prolonged period of time.
Barry, is that a bigger problem for certain parts of the market versus others?
Yeah, sure. Long duration, what we call long duration equity or higher PE multiple growth stocks, their valuation suffers more as that real 10-year yield goes up, the TIPS. On your Bloomberg, it's USGG T10Y. And if you look at that yield going up, it's going to keep pressure all the way into next year, towards the middle of the year, when we have to start worrying about some of the economic data, possibly weakening, unemployment crossing over 4%. These would be precursors to recessionary concerns in the back half of 24.
So, Barry, back end of 24, to have those concerns, you're just pushing them out. Lots of people just pushing out these concerns to the back end of maybe next year. Barry, with that in mind, is there a window here to look for some kind of cyclical rebound that you can get exposure to in stocks?
Yeah, what we've been saying is essentially a pair trade. So long cyclical value, short cyclical growth. So what is that? Cyclical value is energy, capital goods, financials, transportation, materials. Cyclical growth, the short, would be things like media, entertainment, semiconductors, tech hardware, and autos. So that's Alphabet, Meta, Nvidia, Apple, and Tesla. So you're long short on a cyclical basis. And what happens is you get a cyclical rebound. The PMI manufacturing, we think it goes over 50 soon. The industrial production has been strengthening, no recession on the cyclical side. And the other thing to consider is the sticky inflation. The precursors of inflation, like wages and commodities, they don't look so bad to us. We think that they'll stay aloft, no recessionary decline. So when you get that cyclical rebound, sticky bottoming for inflation, you really want to be in a more cyclical profile. And the growth stocks are just, continuously hammered by that rising real yield as the Fed normalizes the long end of the curve.
Barry, I was reading some of your work. You seem to acknowledge one threat to the cycle, energy. Is energy the hedge here for you?
Well, energy is kind of a call option on a tight market. The geopolitics have really filtered into energy. I mean, Saudi Arabia could decide tomorrow to bring the price of oil down, but they've chosen to keep it up. Now, $80 to $90 a barrel, they're probably satisfied. But if you poke up towards $100 a barrel, they could easily increase production and lower the price. So they're being rational actors here in terms of the way they're acting. The irrational side, the one we don't really understand, is what would happen in 2024 with Russia, maybe Iran, on the oil front. Remember, Russia has a presidential election, I believe it's March of 24, and we have one in November of 24. Peak summer driving season is the summer of 24. Their best option from a game theory perspective would be to cause oil to skyrocket into the summer and fall of 24. So higher oil prices with energy stocks is a little bit of a call option on that, not to mention that it's just a sort of a cyclical group right now because it's a demand story relative to supply.
Hey, Barry, good to get your views and an update from you and the team. Barry Bannister there at Stifel. We're about 12 or 13 minutes into the session. I just want to mention where crude is. Brent 90.84, WTI 87.69, negative by about 0.7%. Coming up, Tesla earnings missing the mark.
Tesla had a disproportionately large share of the market because it did have first mover advantage. But first mover advantage does not last forever.
Pierre Ferro of New Street Research joins us next with more on Tesla's disappointing quarter. That conversation coming up.
There are a lot of other car companies out there that can make electric vehicles, and Tesla had a disproportionately large share of the market because it did have first mover advantage. But first mover advantage does not last forever. It does not afford a permanent competitive advantage. You got to keep running to stay ahead because people are coming after you. And what we're seeing is that the competition is catching up. And Tesla is forced to lower prices and deal with lower margins, just like other car companies.
Tesla earnings missing estimates. The CEO Elon Musk discussing some of the challenges, saying this: we dug our own grave with the Cybertruck. Special products that come along only once in a long while are just incredibly difficult to bring to market and to be prosperous. Ed Ludlow has more. Hey, Ed.
Yeah, there's a lot long term to recalculate and reconfigure here. Interest rates was very much top of mind for Elon Musk. To give a specific example of how that manifests itself, Tesla has plans to build a new factory in northern Mexico in Monterrey. And what Elon Musk said is that they will sort of decelerate that process. They cannot go full tilt, is how he put it, and that expansion generally will pick up pace if and when interest rates decline. It's one of these things where suddenly you have market analysts going back to looking at the dot plot and Fed futures funds to work out, Fed fund futures to work out, what the trajectory is for this company. In terms of their response, right, a lot of focus, as we discussed, on automotive gross margin, excluding regulatory credits, coming in at the lowest level in 4 years. They are focusing on cost cutting internally, according to the engineering chief, Lars Morave. And then there's the biting off more than you can chew element, right? The Cybertruck is already 2 years delayed. It will ship starting November 30th, but it's going to take a period of 2 years, according to Musk, into 2025 till they're shipping at volume. a lot of narrative out there about how bad this earnings call was from an investor's perspective, going back to sort of 2018 times. A lot of people focusing as well that Zach Kirkhorn's departure as CFO is now more of a concern. That's a really interesting question to pose to some investors out there.
Ed, thank you, mate. Appreciate your coverage over the last 24 hours. Pierre Ferro of New Street Research joins us now. Cut the price target down to 300, maintaining that buy rating. Pierre, let's get straight to it. Given the direction of margins and where things are heading right now, the question I hear a lot this morning, Pierre, how to value this company? Like any other automaker, what is it?
Yeah, it's a very good question. So if you look at the last 12 months, Tesla reduced its average selling price, so you can roughly translate that into cut prices by a bit more than 15%. Gross margins came down by just over 10 points. So that's definitely a painful journey, let's face it. What's interesting is that it's not so much a question of competition or anything like that. I hear a lot of comments around that. I think it's very misinformed comments. The only reason why Tesla has been cutting prices that aggressively is because you have less people buying cars, and it's an elastic market, and so you need to reduce prices, not because your competitors are hurting you or taking share from you, but because you want to continue to grow and find buyers. So what's interesting in this math, you take prices down 16% and you have your gross margin coming down 10%. That means underlying that you took your cost down by 4 points, 4% average cost per car and cost of goods sold. And that's really what's happening. So Tesla is cutting prices much faster than they can reduce cost. But the good thing is that these price cuts, they'll find a bottom at some point. And what maybe the company kind of telegrammed last night is we're going to see a stabilization, and if we slow down our growth, that's all right in the end. And the thing is that when prices start slowing down, like the price decline starts slowing down, I think like the underlying cost cut, 4 points a year, 1 point a quarter, is extremely sustainable. And this is really what maintains Tesla in a unique position in the market, because they really have an ability by introducing their new batteries, their new form factors, their new manufacturing technologies at a pace that is unprecedented in the industry. They have the ability to maintain their cost leadership and improve it over time. And so to answer your question, sorry, it's a long-winded answer.
No, it's okay. It's a big question.
Ultimately, Tesla will get back, between 20 and 25% gross margin in autos. And when you're asking, how do you value them? I, take the revenues today, I plug in like a 22.5% gross margin. I look at what kind of earnings that reflects in 2024, and I'm looking at the multiple on that. And $300, it's 40 times that. So it's a very safe valuation. Paying 40 times earnings, normalized earnings for a business growing very fast, I think is a good, low end of the valuation range. And that's where I think the stock is going to trade for some time, because it will take time, for hopefully interest rates to come down, or consumers to adjust to it and come back to the market with the new reality of how much it costs to own a car, or more time for prices to come down even more to really trigger that increased adoption. But on the fundamental story, the fact that Tesla is a massive cost leader and a massive product leader in the auto industry, and that where they still have single-digit market share, it's still there. So it's still a very good growth business, and a business that has an extremely strong and defensible right to make money in this industry. So,
I've got about a minute left, Pierre, so I want to squeeze another question in if I can. No, by all means, I think it's the question. There isn't really any other. But I do want to talk about demand for EVs right now. Pierre, what is going on at the moment? You hear about all these unsold EVs piling up elsewhere. What is happening? What's your read on things?
Yeah, I think Elon articulated that very well last night. When you look at how much interest rates have grown, the total cost of ownership of a car today for normal people who have to pay on a monthly basis for their car through a loan or a lease, has gone through the roof. And if anything, I'm surprised the broader auto market is not suffering more than it is today. And I expect the broader auto market to meet more and more disappointing demand. The reason why we haven't seen that much of a broad pullback in autos is because we've been running very, very low on dealer inventories and things like that. So the industry is readjusting to that.
It looks brutal. Pierre, they're screaming at me.
It's going to be
Gotta
brutal.
go. I'm going to save more time for this conversation next time. Pierre Ferro on the latest with Tesla. That stock is lower from New York. This is Bloomberg. From New York, here's the trending diary. Fed Chair Jay Powell speaks at noon Eastern. Goolsbee, Barr, Bostic, Harker, Logan speak later. The House expected to hold a third vote for the speakership, and President Biden addressing the nation at 8 p.m. Eastern Time. From New York City, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.